You have in the chart. Now you just have to go with me and know that this is, the years are messed up in your chart. I don't know why. This is 2016 is what that should say. Let's make this. Let's make it 2016. And this one's 2017. All right, close enough. Okay, so there's our 2016, 2017. So this is what's happening at the end of 2017. So you could do 1 or 2 steps to record the sale. I'm going to show you the 1 step. You can look in your book for how to do it in the 2 steps. After you record the sale of the investments, I've asked you what's the balance in the fair value adjustment account. So let's look at selling. We're just going to do the sale. Okay? So here's what we need to know to sell an asset. And you remember this from other asset sales. I need to take out of the general ledger everything associated with those assets. So I have my investment account balances, and I have my fair value adjustment account balances. So we need to get rid of those. And we need to recognize the cash that we received, which was $75,000. So my entry is going to have $75,000 in cash to start. All right, and then I'm also going to show that I have to get rid of the fair value adjustment balance for those investments. So if we look back up here, you see there is a $1,000 credit and a $2,000 credit. Put those together, it's a $3,000 credit. So in my entry here, fair value adjustment, to back those out, I'm going to do a debit for $3,000. I'm going to get rid of the investment account. I'm just going to put an M for mining, so I don't have to spell it all out. If you look back above, the investment in mining was the $42,000, so that's what I'm going to put in my entry. And the toys and things was $30,000, so I'm going to get rid of $42,000 on investment in mining, and I'm going to get rid of. We might have Brody might join us here in a second. He's pacing around like he needs to talk. And this is $30,000. And now, just to make the journal entry balance, I'm going to recognize a gain on the sale of whatever it takes, which is $6,000. Okay, so that would be the 1-step approach. I think that's pretty straightforward. You're basically taking all those accounts off your books, right? Just FYI, the 2-step approach is you bring them to fair value first. So you would do an entry to bring mining from 41 up to 43, and toys and things from 28 up to 32. So it would be a $6,000 fair value adjustment. I think the 1-step approach makes more sense, or it's just easier. So then I have a question for you. After you record those investments, what's the balance in the fair value adjustment account? Well, why don't we just look real quick. fair value adjustment account. Sorry, I'm writing with my fingers. I will stop doing that because it's hard to read. All right, and so before we did anything, we had, I'm going to just break all the pieces out so we can see them all. We had a 2,000 credit, whoops, for toys and things. We had a 13,000. Whoops, no. That's where my credits. That's what we had on the credit side. And we had a $13,000 debit. So we had our toys and things and our mining, and this 13,000 is for Situation Corp, right? We had 13,000. So we put that together, we had a $10,000 balance, right? 13 minus 3, 10. Okay. So after we record the entry that we just made, that was a debit to fair value adjustment. All right, so after we do that, after we make this entry and you look at this balance, you would go, oh yeah, I get that balance. Yeah, that balance is 13,000, right? So that's all that remains. That's what remains. This is the 13,000. Okay, so that's the answer to number 2, the first number 2. At year end, you need to fix the fair value adjustment account to its required balance for the remaining investments. So the remaining investment is this one, Situation Corp. At the end of the year, it's the same cost. That didn't change. But now the fair value is 65. So 65 minus 48 tells you should have a balance here of 17,000. That is the balance you need in the fair value adjustment account. The question is, what journal entry do you need to do to get there? All right, so that's what's the journal entry that you would do for my second number 2. Right, so then that's just a plain old fair value adjustment entry. So that is going to be a debit to fair value adjustment for the difference, which is 4,000. And we're talking about passive equity investments. So that unrealized gain goes on the income statement. Or let's see, I've been calling them net income. Either one would be fine, meaning the same thing. And that would be my entry, right? Once I put 4,000 in here, it's going to leave me with $17,000 balance. Question 3 says, what's the total gain or loss that impacted the income statement? This is just a question I have on here occasionally. This kind of question to make you just go back and think, okay, looking at these 2 entries, what would have impacted my bottom line? Would my net income for the year have been higher or lower because of this transaction? Or these transactions, and you would look and say, okay, there's 6,000 gain. Here's 4,000 gain. So if you were looking for an answer for number 3, it would be positive 10,000. There we go. That's always happy. Was up 10,000. Okay, that's what happened. 6,000 from the sale and 4,000 from that fair value adjustment. That is selling equity investments, passive equity investment sale. We have a few quiz questions. Blah, blah, blah. Check the fair value adjustment. Just a reminder, it's a permanent balance. So every year you adjust it. It doesn't zero out. Okay, so what we have now is the equity method investments. We're going to sale. This activity just brings together all the entries we did at the beginning of day 24. Or if you're in the evening class, we did these entries on Halloween. This is our excess basis. But here I'm just asking you to use a T account. We made a sale for $1,010,000. Prepare the T account and figure out what our sell entry would look like, where we generate cash and remove those balances. So I can start the entry because I know we got $1,010,000 in cash. Okay, what you need to do is a T account. And I'm actually not going to do this problem all the way through. I'm just going to stop right here and say, you know what would happen, because I know you do know what would happen. You're going to, that's kind of crazy. You're going to take the investment and Happy Pup off of your books for whatever you add up that goes in the T account. So I'm going to put that as my first question mark. And then whatever it takes to balance that journal entry, gain or loss, would go in the middle. Okay? You can do this one. You just got to do a T account. Figure out what that balance is. And that's going to give you your answer. So you remove everything from the general ledger and use a gain or a loss to balance. That's your general taking things off the balance sheet, derecognition type entry. It's a couple of quiz questions to see if you got the right number. We finished off class. I just showed you. These are also in Canvas. Just two great summaries of all of the entries we've done in Chapter 12. So that's it.